Okay, as we move on to the second section of this class, um, now we're going to actually get into the audit itself. The first section, we talked about internal control. We talked about the things that we need to look at before starting the audit and the auditing profession. Over here now, we will start with different sections that need to be audited. And we start in the order of the balance sheet. So first we look at cash, okay? Auditing of cash. The most liquid asset, the cash on the balance sheet includes all cash in the bank accounts plus petty cash. Okay, what are our objectives? We will continue to see this comment again and again. We need to get an understanding of the company's overall environment and what are the risks related to cash. Of course, get an understanding of internal control. Assess the risk of misstatements. What can go wrong? Okay. So when we start this, what are we trying to ascertain? The cash does exist. That's what we want to make sure. Accuracy. It's accurately recorded. Completely recorded. The cutoff also, in a way, these two are the same. The client has rights. That the clients do actually own this cash, and it's disclosed correctly. Any restricted funds are disclosed. Anything that isn't that needs to be disclosed is also disclosed. So every organization has a revenue cycle and an expenditure cycle. Cash in and cash out. This is what we are ascertaining, but to ascertain this, we need to understand the two cycles. Cash in, cash out. Customer puts in an order. A credit process needs to be looked at. How do we grant credits? Separate from the sales cycle or the sales department. Goods are shipped. Customers are billed. Cash is collected and deposited in the bank, and the bank statements are then reconciled. That's the revenue cycle. Purchase order is prepared. Invoices come in, and you pay the bills. Okay, that's, of course, there's much more to it than that, the receiving department and matching the purchase orders. But as far as cash, related to cash is concerned, when you purchase, you pay. That's cash out. Of course, there are other transactions, cash transactions as well. If you get a loan, that's a cash transaction. Okay. Investors invest, that's a cash transaction, but we're trying to understand these two cycles first. And so the controls related to that: collecting cash, dispersing, and then reconciling. Reconciling cash in and cash out means doing a bank statement reconciliation. Cash receipts. Separation of duties are needed. People who are in charge of, if you are in charge of cash registers, you obviously should also not be in charge of accounting or posting those sales to the ledger. Segregation of duties. Some employees receive cash and checks, and they have the initial custody. So it is a good control, because once they receive the cash, they are in control of the cash. So it's a good control to have two people for segregation of duties. Restrictive endorsement of the checks before you mail it, list of cash receipts, and then separate actual cash from record-keeping documents. Okay, now let's talk about this. It is not always necessary that you need to have this many employees, but it is ideally, in a big corporation, ideally it is desirable to have this process. Nowadays, as you know, manual cash doesn't happen that much. It's always electronic transactions. Okay, so you have two people to open the mail and containing the receipts. So they both, when you have two people, there's less chance of fraud. Restrictive endorsement of the checks. Prepare a list of cash receipts and separate actual cash from record-keeping documents. Okay, now once you get the cash in, you need to update the ledger. This is the entry, debit, cash, credit, accounts receivable. Who keeps the cash until it is deposited? Subsidiary records should match with the general records, reconciliation of the subsidiary accounts, monthly collection cycle and mailing outstanding, and collection activity in past due accounts. So we need to look at all these things anytime there is cash receipt. But as I told you, nowadays the cash transactions does not happen a lot. It's electronic transfers and mailing to lockbox. This is an important question for multiple choice. A post office box controlled by a company's bank. Okay, the bank will pick up the mail and deposit to the company's cash account. Company gets a remittance advice. For cash sales, separation of duties is a good control. What do we mean by that? If you have cash, of course, you cannot completely not have cash in retail business. For example, Jewel and J.C. Penney's and Sears. You know that the person on the cash register is separate from the person who is in the customer service and who is doing accounting in the head office. So cashier selling you movie tickets and person accepting the tickets at the gate should be separate individuals. Why? Think about it. If they both are the same people and he is your best friend, you could be getting free tickets and he would also be letting you into the theater. Okay? That's why, in a way, it is segregation of duties. Cash collections department, after receiving cash, should forward information to accounting. Think, who handles cash nowadays? At the grocery stores or retail stores, that's where you see a lot of cash transactions. Okay? And what happens, the cashier at the end of the day will take the cash to the customer service. They will then roll it up, deposit in the bank, give the bank tickets to the accounting department, and then the accounting department will be doing the processing function. So segregation of duties. Okay, every month bank statements need to be reconciled. So that is important as well. Okay, so lockbox, you'll see a few multiple choice questions on that. The best way and the safest way for cash, for retail stores and those kind of businesses where cash is handled, segregation of duties is the best way to avoid fraud. Okay, and so that was the cash collections, and then you have cash disbursements. Over here also segregation of duties matters. In this cycle, it is very important that a voucher is prepared. In a cash disbursement cycle, and we will look at this more when we look at the accounts payable cycle. First, a purchase order is issued, goods are received through the receiving department, invoice is sent. So the PO, a copy of the PO is sent to the accounts payable, a copy of the receiving report is also sent to the accounts payable, then the invoice comes in, all the three are matched, a voucher package is created, and the treasurer then is going to, the treasurer's department then prepares the check and signs the check. Or accounts payable may prepare the check and the treasurer then signs the checks. Okay, and at that point supporting documents are defaced or paid, it is stamped paid and then filed. Okay, and then immediately checks should be mailed out so checks are not left unattended. Okay, so that's the disbursement cycle. Again, segregation of duties is important over here as well. Okay, but the voucher package is important, not necessarily for this chapter, but for the accounts payable cycle. Voucher package means identify what was ordered from the purchase order, identify what was actually received from the receiving report, and identify what was invoiced. And once the three match, only then you can make the payment. Okay, kiting. So let's talk about kiting and lapping for cash. Many businesses maintain checking accounts with a number of banks and often find it necessary to transfer funds from one bank to another. Let's talk about that. You have cash in one bank account and you do not have enough cash in another bank account. If you do a transfer, the balance can float in the two accounts for a few days together. Okay, the check is not cleared from this bank, but the check has been deposited, so it shows balance here and it shows balance here as well. At the end of the year, think about that entry: debit cash, credit sales. Okay, And so the balance is included on both sides at both banks. And kiting refers to manipulations that will utilize such temporarily overstated. The bank balance is overstated on both sides. And what you're trying to do is, conceal a cash shortage because you want to make sure that year end is reconciled and then the cash shortage is carried forward to the next year and on and on. So to prevent that, you may have to do a test of transfers, which is, you're trying to catch kiting. And there's a good example given to you, which you should look at as well. Lapping. You know that movie Catch Me If You Can? That's lapping. For example, you have someone in charge of accounts receivable, and that person, or updating accounts receivable, and that person is also in charge of collecting cash. What can that person do? They receive cash of $200. They only apply 180 to that customer, pocket $20. Next day, they receive another cash of $250. They decide to only apply $220 and then apply 20 to the previous customer and then pocket $10. So they are continuously, there's a scheme going on where they are trying to make sure that they are applying payments subsequently, and that is called lapping. And you'll see a few multiple choice questions on this as well. Okay, so that's basically a brief discussion of cash. A few things to remember: bank reconciliations, segregation of duties, to make sure that the record keeping function and the custodian functions are separate. Okay, understanding the cash cycle, cash receipt cycle, and cash disbursement cycle is important. In addition to cash, in this chapter we are also looking at financial investments. Okay, and in the financial investments, before we start, let's understand them real quick, what they're all about. Now, derivatives, options. Okay, let's understand what they are. And maybe you already know about this, but I'm just going with the presumption that you don't. A contract between two parties to buy, sell, swap, or have option to sell financial instruments. On this particular day, regardless of the market price, I have the option of buying the stock for $20. You're taking a risk, right? The market price may be $50, the market price may be $10, but it's an option that you have. That's an option. Future contract, a promise to buy or sell at a certain date in the future. A promise to buy or sell at a specific point in future when price is paid before the contract happens. I will pay you $20 right now, but I can buy whenever I want to. Okay, and whenever I wish to buy, I only pay $20 for that particular financial instrument. Okay, and here I can buy anytime at a certain date for a fixed price. Okay, now the difference is that between future and forward is that you pay for future contract, you are determining the price in advance regardless of what the price is then in the market. Okay, you already decided that price. So that's a risk that you take, and that happens with currencies as well, depending on political stability. If I buy, the currency of Iraq today, or Afghanistan today, and I hope that financial stability over the next 10 years will help this country, or I should say political stability will help, and the currency may go up, then that's something that you are doing is, in a way, it's an option also. Okay, so that's what you need to keep in mind. A swap, exchange future cash flows, and that is also used for currencies. On this particular day, I may get this much for the currency regardless of what the currency is in the market. Okay, so let's say the currency appreciates 5 years from now, but you have the contract based on today's terms. Political stability made the country's currency better. You earn money, or it could go the other way. It could be worse. Okay, but those are the kind of financial instruments that you would also audit to see if there are proper contracts in place, and this particular instrument that you are showing on the balance sheet or the client is showing on the balance sheet is valued correctly. Okay, hedging, a strategy designed to minimize exposure to an unwanted business risk. Southwest Airlines, when the fuel price went up, the least that the least that the one airline that was hit the least was Southwest Airlines. Why is that? Because they had negotiated good rates in the past. That 20 years from now, this is what we'll pay for the oil, regardless of what the market is. Okay? And that's called hedging. And all these securities, they are liquid assets, and which may increase the risk of fraud, but they also increase the risk. The assertion of valuation and presentation and disclosure also gets very important. So you may need a specialist to audit these things. I am certainly not a financial expert, and if I were to audit these instruments, I may know the definitions, but I may need a specialist help because I haven't specialized in that field. Okay, because they may need to do all these things: estimate of fair values, speculation, hedging experts, complex accounting methods. So all these things, I may not know the rules for maintaining a derivative as a hedge. Complex rules. I may not know these things, and I may need the help of a specialist. So before I start the audit for financial instruments, I may need to look at the balance sheet and decide what I need to audit. So this is equally important as well. Okay. So this again is a short chapter, but it is short in the information, but there are quite a few multiple choice questions. That's how the chapters are going to be from here on, where it is more about actually doing the multiple choice questions, and which will make the material more easier. Okay, thank you very much.